Okay, it is 7 p.m. Eastern Standard Time, right? I'm just going to go through several aspects of business and financial analysis. So before we get to that point, um, let's just let's just familiarize yourself with exactly who I am. I'm a Dr. Homer Eli Fenor. I teach business courses. I teach accounting courses. I teach psych courses. I teach communication courses. I teach nursing courses. I teach education courses. So whatever type of course that it is, I'm pretty fluid, and I try to embody everything that I know to just be compressed into one piece of subject matter. And all of these topics are generally things that I love. And hopefully, when I share this type of information, that you too can have that same type of enthusiasm that I have. Okay. So now let's let's look at exactly what this is with what I shared. Right. So what I shared here is a PowerPoint presentation that talks about entrepreneurship, and this is based on the entrepreneurship book. It's chapter 8, speaking about business and financial analysis. Right. So some learning objectives that we need to keep in mind is that we need to explain and really understand the use of hypothesis-driven experimentation. And then we'll begin to describe the importance of solid um, financial foundation in entrepreneurial business. We'll discuss techniques for measuring performance, explain ratio analysis, explain deviation analysis, explain sensitivity analysis if we get time. Describe the use of short surveys in business and the analysis that to analyze the importance of having a measurement focus. So the chapter just begins with the importance of solid financial foundation and techniques for measuring performance. And then it discusses certain analysis. Of course, we should all be analytical in our mindset as to what business is and the importance of all of these measures. Just hold on, take a moment to read this. Okay, so the hypothesis-driven analysis. So the hypothesis-driven analysis suggests that we're going to use many small experiments with customers in order to refine the product or services that we're offering. So what does this mean? With this means that we're going to take small risks in order to assess if it's a good business model. Is it something that we should generally be getting into, right? It requires a significant amount of care, experiment, design, measurement, and refinement, of course, because we're trying to see if this really makes sense to even do, right? So in any type of thought process or any type of business that you get into, you have to try to do a small experiment. So you can say in line, it's kind of like cooking. Instead of cooking a big Thanksgiving meal that you've never cooked before, it's maybe good to try to cook that meal by yourself and taste it by yourself in order to assess exactly what you need to change, right? So, just as in business, we're trying to get small snippets until we go to the grand scheme of things. One other type of hypothesis is hypothesis driven analysis, too. Of course, it's done in small batches. It's crafting up a solution and then seeing how customers react to it. So, in the example of my cooking example, is that you're going to craft up some type of meal and see how the customers react to it. Because their reaction towards it is the best metric to understand what you should change at that time, right? So keeping the product or service the same for some customers and changing it for the other customers. So if you have a small sample of individuals, maybe some like it the way that it is, and maybe some like it just change just a little bit. And maybe you can have that little variation. So one example of this is I remember when I was cooking Haitian beef patty pastries. And what I was doing was I was having a sweet taste to it all. Some people liked the sweetness, some people didn't like the sweetness. Some people liked the sweetness, but because it was sweet and they had diabetes, they said that they couldn't eat the sweet type of beef patties, Haitian beef patties that I was creating, right? So, what we need to understand is that everyone is going to have a certain type of likeness to whatever it is that we're doing. And essentially, we should track those results. So I tracked the results and was able to split up exactly the type of pastries that I was cooking for these individuals. So, what's the importance of solid financial foundation in an entrepreneurial business? Well, it all starts out with the mission. What is the mission of your organization? We should always think about that, right? Because there, if you don't have a mission, if you don't have a goal, it's pretty difficult to really try to figure out exactly where you should be leading. Where is your direction, right? So if the mission is low cost, the focus would be the control of expenses and the measuring of outcomes at regular intervals. So if the mission is low cost, so we can say, for instance, Dollar Tree, Dollar General, or any type of dollar store, the mission is a low cost. So the control would be the expenses, whatever they're purchasing the items at, and just measure them at regular intervals and really understanding, are we meeting the customer's need? Are these the type of dollar products that we should have in our organization in order to sell? So in measuring this performance, it will be limited to those areas that are critical to profit, right? So sometimes we don't need to do a whole analysis on absolutely everything, right? What we can do is just have a small snippet, a very small snippet, very, very small snippet of exactly what we're getting into, right? And we're going to proceed from the general to the specific. So classic analysis techniques, we're going to have ratio analysis, deviation analysis, sensitivity analysis, and short surveys. So there's different types of analytical tools that you can use in order to better assess if you're doing the right thing for your product. Okay. Ratio analysis, right? So there's a series of ratios that a company must review in order to provide a better picture of the health of the organization. So some may say, let's focus on liquidity, which is basically how much cash do we have in reserves that we're able to use. The activity mainly being how much are we actually making during that time. Our leverage, how much more money do we have over what we need to have that type of leverage. And profitability, is what we're doing profitable? And sometimes we may break this down into different departments, right? So you may be selling a certain clothing item and you think you're making money off of it, but once you start adding in all the storage costs and maybe the transportation costs, maybe you're not really making as much money as you possibly can. So this is why sometimes we often just review our items and choose the best items that are selling well. And oftentimes what we do too is we just sell them at a discount. Sell them at a discount so then we can just get rid of them and just focus on our profitable measures. So with liquidity ratios, ratios that measure the short-term ability of the firm to meet its obligations, financial liquidity is critical for success. So you need to be able to pay your electricity bill. You need to be able to pay your gas bill or water bill. right? So all of these things are critical for success, but more specifically, you need to be able to pay your wages. That's even more important for your short-term growth. Of course, we have commonly used ratios. These are ratios that accountants usually use. When we speak about current assets are those that have cash, accounts receivable, inventory. And of course, we need to better understand exactly what current assets are to be able to assess how do we divide current assets divided by current liabilities, right? So when we say current, it's anything that's 12 months or under. 12 months and under is current. We do have liquidity ratios. And with these liquidity ratios, so you have, we have some certain numbers here. The current ratio, so you have uh, 91,400 divided by 54,400, and that's the current ratio. And as we indicated before, it's current assets divided by current liabilities. Current assets divided by current liabilities. And we have the quick ratio here, which is current assets minus inventory divided by liabilities. Okay. But there's a certain issue with these ratio analysis, right? So a lot of times they have little or no relevance to entrepreneurial businesses, and that is because um, usually what's really affected is that in bigger numbers. Or some of these things we don't even have in our organizations, or many entrepreneurs can't even really assess what is their current asset of what they have, right? So it's very, very difficult. So we also have activity ratios, ratios that measure the efficiency with which an entrepreneur handling the resources of the business, right? So the specific ratios can be combined with inventory turnover, account receivable turnover, total fixed asset turnover ratio. So there's all these other ratios that we can assess to better understand the activity of our business, right? And commonly used ratios upon this, uh, inventory turnover, cost of goods sold inventory, um, accounts receivable turnover, total fixed asset turnover. So these are a lot of the common ratios that accountants may use, and it may or may not help out your business. I know that if you're going to write a business plan, these ratios would be very, very beneficial to you. And in leveraging these ratios, we have ratios of interest, debt to equity ratio. So these are the type of ratios that are very important when we speak about just when we speak about organizations that are banks that are trying to assess if you're a huge liability to them or not, right? So the ratios of interest, whether it be debt to equity ratio, debt to assets times interest earned, are all important. We have different sets of just profitability ratios. Five ratios of interest are oftentimes the gross margin, profit margin ratio, operating profit margin, net profit margin, return on assets, and return on equity. So essentially, what we're doing is we want to assess what is a good return on our assets, what is a good return on our equity, what is a good return on anything that we're doing. So anything that we're doing in business, we're trying to see what can we receive from it? What is our return on it? Right? So even though businesses vary, the core concepts are just very basic. So some of the similarities and differences between financials for restaurants versus a clothing store may be, with a restaurant, you're going to have food, right? The type of inventory that you have in a restaurant is going to spoil. With clothes, it may not spoil, but it may go out of style. But you may be able to hold it for a very long time, right? So the financials may look different, but the goal is pretty much the same. Where we need a certain profit ratio in order to be successful. Okay, ratios in short are just valuable tools for the firm. Owners usually use one or two ratios from each category, right? And good data collection system is necessary. So if you don't have good data collection, how can you truly assess what you're doing is absolutely correct, right? So interpreting these type of ratio means comparing them over time, which is very difficult for entrepreneurial business owners. Things are going so quickly that sometimes you just fail to address your recording procedures, right? But just your analytical skills based on the data you collect will surely help you in the long run. Um, this is one thing that I think is also good. Sometimes you can use some short surveys in business. Short surveys, as it indicates here, gather contextual information that is subject to interpretation. So everyone is going to have a different view based on what they see on the short survey. And it's great in its great importance to whatever topic area that you're discussing. So even if you're using a Likert scale, which can go through 1 through 5 or bad to good or bad to great, that's very ambiguous. It may not be exactly what it is that you're seeking, right? Because your analysis of what is good is going to be different to a customer. So that's why it's good to have more questions that are fill in the blank, more questions that are in essay form, to really try to grasp exactly what the person completing the survey is trying to depict, right? And because of that, depending upon what you're researching, some bias is involved. And questions should try to be as unbiased as possible and relate directly to the mission of the strategy of the company so you have good data in front of you. So again, the importance of having a measurement focus, um, parts of a business that must be done just to be considered a part of that particular industry, and what's unique areas where the business really tries to differentiate itself. So in any type of business type of area, um, you're trying to be different than everyone in the organization and in your type of industry. Dunkin' Donuts has a different mission than Starbucks. We can all assess that. McDonald's has a different mission than Burger King. Bob's Stores has a different mission than Raymart and Flanagan. So they're all in the same industry, but they just have different goals of how they're going to produce their income based on the type of demographic that they cater to. So the focus should be on areas providing competitive advantage. What advantage does your organization have? And as it indicates here, concentrating the analysis efforts on those areas that are unique puts the founder's focus on those areas that can create a differentiation for the business compared to those of the competitors. And that's a little bit about business analysis.